I feel like I'm the Count on Sesame Street, right? Yesterday was three down days in a row. Today is four down days in a row. But still holding pretty decent support levels that would offer some expectations for a bounce. But a little bit of a wrinkle today and from an intermarket relationship that can impact that. So I break that down as well as a trade idea on how to take advantage of that wrinkle. So let's go ahead and get started. Today is Thursday, March the 15th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Glad you found us. Keep coming back. Subscribe to our YouTube channel. Click that red subscribe button right down below the video here. Also, while you're down there, click that thumbs up icon. That lets me know that you like today's video. And it lets me know that you want me to keep doing it. So if you want me to do this video again tomorrow, let me know with one click, that thumbs up icon down there. Comment on anything that stands out to you from today's video. You have to scroll down further to be able to find the comment section down there at the bottom. Also, join our daily email list. I send out an email every day with timestamp summaries of what we talk about in these videos, hyperlinked timestamp summaries. So make sure you're on that list to get that email. There's a description. There's a link that I've highlighted in the description that you can go to join it. Follow me on Twitter for more content in addition to these videos. You can see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. We got up of over 100. We got to like the 115 or so. So good. Thank you very much. Again, that's another way to let me know that you want me to keep doing this by clicking that like button on Twitter. And then it lets Twitter know that you want to keep receiving my tweets and seeing all my tweets there. And then finally, join our Market Outlook community on Facebook. The address is up there at the top, at the top of the screen. There's also a link in the description. If you click on that, we'll take you there, and you can join about 950 of us still. So join us and keep this discussion going. Some great discussions we've been having, great posts from others like you that have been going on in that community. So make sure you join to see those. All right, let's take a look now at the S&P 500 here with the market forecast indicator, as always. Starting off with that, with the intermediate line rising still, so still showing a bullish posture despite a 4-day losing streak that, if you recall, we're sitting here right at that 38% Fibonacci retracement. So trading in the lower half of yesterday's range for most of the day today, but a really small range after only having a 32-point range, coming off of 43, a 32, and now down to 21. It seems like most everybody kind of took the day off to start watching some basketball games, especially those Loyola Chicago fans that are out there, and almost those Pennsylvania fans. That was so close, so close. One of the games that I had picked for my historic 16 seed upset this year, but didn't happen. Close. But as you can see, the near-term line dropping into the reversal zone. I remember how yesterday we talked, we don't really want that from a bullish perspective. The momentum line stayed down there for a third day, which is not normal. I mean, you know, we got, what, we're at 9.69, yesterday 8.86, the day before that 8.36, so not really normal for it to stay that low for that long. You can see it usually pops down and back up unless it really goes to an extreme low. But we didn't hit the extreme low here. We're at that 8, 9 level. We're still above 5. But below 5 is the extreme when you see these. And that's when you really start to worry about trend changes. And so, of course, we're still with the near-term line as low as it is, we're still at a low point here that can easily, still be bullish. In fact, the near-term line being below 50 is only 2 days, and the typical range on a bullish trend for the near-term line to be below 50, but usually above 20, is 1 to 3 days. So really, the only thing we're lacking for this to be a bullish near-term high point or low point is the near-term line below above 20. It's we got 2 days down there. And now it would have been nice to have more time up above 50, but it was better than the previous bullish run. It did get up to a slightly higher high after coming up off of a higher low point. And it also, like I said before, got back to that trend line, which happens to be, in this case, acting as a resistance level, that average return for a calendar year where the month of January produces at least a 5% return. That average return for the calendar year being 23%. Great data coming from Ryan Dietrich there, one of the great follows I have on Twitter that I usually try to share with you whenever he posts some interesting stuff just like that. Market sentiment still pointed down, which is why we're getting so many down days. Market sentiment, when it's pointed lower, means the path of least resistance is to the downside. I mean, we've had what would that be? 1, 2, 3, 4, 5 up days with one down day in the middle. Then you had 3 down. With around those 5 up days, you had 1 in the middle, 4 on this end, 3 on that end. So you've had 1, 2, 3, 4, 5, 6, 7, 8. 8 out of the past 13 days have been to the downside. Yet, from 226 when that started, we were at 27.79. We're at 27.47 right now. So we're not that far off of that high point where we're currently at after that 13-day window. That's what a falling market sentiment means. It means that the path of least resistance is to the upside. It doesn't have to mean that we're on a bearish trend. We're getting more down days and up days. That's just the nature of the long-term sentiment that we have right now. But intermediate posture is still turning bullish, and the longer it gets, if it does get up into the reversal zone and stay there, then that will be bullish. If it does not do that, if for whatever reason this high point area here holds and we reverse to the downside, and this does not get in the reversal zone, then we know that's going to be more bearish. That we've got, it's like a phantom red arrow on the stochastic indicator, for an example. But we wouldn't expect that yet because of the bullish, the bullish low point and everything else that we're seeing that we talked about yesterday, and we'll talk about more here in this video. Short-term sentiment improved a little bit on the Dow as it popped up a little bit there. Intermediate line is kind of flattening around the midpoint. So really, from an intermediate basis, we've been trading since the middle of February, right around 50, right here. So that's about as flat as you could possibly be. So in other words, it's coiling. So which direction would you expect? And there was a great post in our Facebook group community. If you haven't joined yet, again, it's Groups at Market Outlook. And I wanted to highlight this post. The idea, and there was a great question, which way are we going to go up here? Is it going to go up or is it going to go down? We're coiling. And I ventured to comment on that, and my guess was to the upside. And simply because the trend you have going into the coil, you expect to come out of the coil. Simple as that. And doesn't, of course, nothing's 100%, but that's what I would expect based off what I saw there on that first move. So that's what you see right now. Again, that intermediate posture cannot be more sideways than what you're seeing. The NASDAQ composite continues to pull down back towards that 7,500 area. Still not quite to the 38% Fibonacci where the old high is. Kind of messing around with the 7,500 where that old high was back there. 3-day losing streak coming off that bearish engulfing pattern. Near trend line getting a little bit more in the reversal zone. 3rd day in a row with that momentum line in the oversold territory. But strong bullish posture, and obviously would be a much higher near-term low point than the last one we had. And then finally to Russell 2000, the small cap index here, showing a very similar pattern. You can see pulling back down, almost getting past the 23% fib retracement, almost to the 38, not anywhere close yet to that old high point. Near-term line falling in the reversal zone, but still would be a much higher near-term low than this one. So that strong bullish posture on both the NASDAQ and the Russell still not in jeopardy yet per se. Not really until you break that 50% Fibonacci, which would also be that 1550 level, which has acted as an area of resistance before, even with that little fake out breakout that we had at the end of the month. Again, the pullback on the S&P is still not threatening the 50-day moving average yet. We're still hovering around that 2750. Both the 50 and the 200 are still rising. Of course, 200 rising a lot faster. That's going to be the case now for the next so many weeks. There's going to be a time where the 50-day bounces up a little bit and pulls away a little bit, but not very much, and most likely would be diverging on a long-term basis now that we're in. See, we're not in bullish expansion mode anymore. That ended right there. Now we're in kind of grinding mode. Again, similar to what we saw over here that took place over more than a year. We peaked on the momentum, this expansion in the beginning of 14 in a year and a half. The grinding time frame took a year and a half, and there was a pretty decent return I mean, from the peak of the momentum that we had to the last highest weekly close that we had in July before we really broke down. You know, that's a look at the second number here over to the right. That's a 9%. You know, it's a year and a half, and the almost a 10% annualized return for that year and a half time frame. So per year. So you know, that's not a bad return for a grinding period, and that's, you know, that's kind of the period that we're in right now on this long-term basis. If you look at the 3 green arrow charts, excuse me. There we go. 3 green arrow chart, you can see pulling back, the MACD pulling back down, stochastics coming down. They're both still above their moving averages, so and we're just barely closing. I mean, we were a smidge below the 8-day moving average. Yesterday, we're a little bit more below and still traded the whole day above the 17. So, yes, the 30-day moving average is falling, and that's not bullish. That's why we really can't get going here. We need to kind of get above this 8 and pull away so that these lines can convert or diverge. MACD convergence, divergence, right? We need that divergence to occur, but at least we have all the steps that we need, right? We have the 8 above the 17, we have both above the 30, so the opportunity is there for it to diverge. You know, and once we kind of get going on this, but that's one of the reasons why it's kind of struggling a little bit, because we don't have a bullish trend quite yet according to the 6-week moving average. All right, now let's take a look at the intraday move here. Let me get rid of this. There we go. So, like I said, trading in the lower half of yesterday's range, but a very small range, so just over 2 points, which is the smallest that we've had for a while. Just over 2 points. You know, trading around 275, that's an important figure. It wasn't for resistance before. It's kind of holding that again now for support to the downside. If you take a look at the take a look at the volume today. So a very small range, you know, the range has gotten down, the volume has come back down, back below average at 81 million. The range again, 2.18 points. You put that in context here. 2.18 points is well below the average. 80 some odd million is below the average. Now the average has been falling pretty sharply here from what it was during this time frame, so that's a good sign. This is starting to come down too, so that's a positive sign. It's a bullish sign for stocks when these lines are dropping. And while the average can, you know, the average volume will get down and stay down for a while, there's still plenty of room for this average range to come down. And, you know, if we were to come back down to the downside, if we were kind of like, if this is going to be like a wedge pattern here, if we were to draw some kind of wedge, something like that, and like this, like that, and we break out of this to the downside, you know, bearish move into it, a bearish move out of it, kind of that kind of an idea, then that's gonna, it's not gonna coincide with, whoops, it's not gonna coincide. That's not what I wanted. I wanted to do this one. It's not gonna coincide with falling trading ranges, right? It's gonna have bigger moves to the downside, so that would come back up again, and it can definitely do that. But usually when you're, you know, when you're at these high levels and you're starting to fall, that usually means that we've bottomed out with these big ranges and big lower shadows, and now we're kind of grinding our way up. And there just happens to be more volatility, and that's the nature of the market. We're at, you know, 17, our average volatility here, which now we need to duplicate that because we've got the high point. So we've had a lower high point form on here. We've had a lower high point form on the volatility. Man, I cannot click this today. Let's move that because it's kind of more right there. So that's a much lower high than the last high that we had on the MACD and stochastics. So again, the expectation is that we get a lower low. Now again, I do not expect us to get below 10 again on volatility. I think we are in a period of time now where volatility is going to be higher, and volatility very well, if I go back out to a longer time frame, you know, the peaks before was right about 12.5 to 15. Right now we're using 15 for support, you know, based on these old highs. 12.5 also is going to act as a strong support level too. That's probably where we're going to bottom out on any good strong bullish trends, is in that 12.5 area. Now of course we could get back down below 10, But considering we busted out of volatility so big to that 40 level, which we just haven't seen, I mean, for multiple years, we haven't seen volatility get all the way up there for so long. It's been really the middle of 2015 was the last time, the August time frame. And even then, see it dropped down to 15 and made another run up to the high 20s in the beginning of 2016 before coming down again 12 to 15, another pop, then a little bit below 12.5, another pop, then a little bit below, and then we had down. So again, based on what we saw before, when we got this high before, we probably won't get down there, especially anytime soon. We could eventually, but not based on what we've seen in the past. Most likely we'll kind of bottom out here, and there can be some volatility. I would not be surprised if 2018 is a period of a higher average VIX than what we saw in 2017, where it was historically low. Of course, on a relative basis, it continues to be right in that neutral range. And so again, another reason why we're not that bearish, not until it gets back above 1, right? When it gets above 1, if it's trading above 1, now we've got reason to be more concerned about some sustained bearishness. Right now, it's still it's struggling to get too far into the neutral range, which suggests, again, nothing more than near-term pullback. All right, now let's transition to what's driving the price action today. And really, it came about, there was some economic data that came out today. On the calendar, we had jobless claims, which continue to be unbelievably low. Look how low that 4-week average is. So very strong employment. And the Empire State Manufacturing Survey, after coming down for multiple months, popped back up to its high levels that we had back here later in the year last year in anticipation of those tax reform. So strong number there. Import and export prices, a good reflection of demand of of domestic and foreign goods. They're still very strong, still at high levels, 3.5% import, 3.3% export, down a smidgen, but still at relatively high levels there. You look at the housing market index. This is a home builder sentiment survey, still in the 70s, so still not as high. We've been higher before, but still at very, very high levels relative to where we've been in the past, pulling back a little bit. And the housing sector has been pulling back. You've got higher interest rates, you have higher prices, you have a good job market, and you have some growth in wages, but not a lot. And so you're getting some pressure on that housing market there. And Treasury International Capital doesn't really impact the markets too much. If there's going to be a big trade deficit, which is the big problem, right, publicly, then you have to that's okay as long as there's foreign capital coming in exchange for our dollars. If our dollars are leaving in trade, then as long as they're coming back in capital, so money that goes into our bond market, into our stock market, and real estate and things like that, then that's what this measures. Mainly treasuries and stocks or equities are what this is looking for. But still, a lot of money still coming in, and that's a good sign as long as it stays positive and stays as high or higher than the trade deficit. That's why we've been able to have a trade deficit for as many years as we've had. So, that was all the data. And from an economic surprise index, while it still continues to fall globally, and Treasury yields have been 10-year yields and everybody's corresponding respective bonds have been falling, but not the U.S. a little bit, but not as much, because while our index has fallen a little bit, it's still very high and holding because of the strength that we're seeing there. The rate hike odds, the odds of a rate hike have gone back up, at least in March. In June, it's still kind of holding steady after yesterday's drop at about that 70% area. You can see still about 71 or 73%. So still kind of holding pretty steady, a little higher than what we saw when we looked at this yesterday. But really what the big driver, besides crude oil, which gapped up and stayed up all day long, finished at its highs, was the king dollar talk that we heard from our new Economic Council chair. And from what I understand too, some chatter, some strong dollar chatter from the Treasury Secretary, push the dollar up, and a strong dollar puts pressure. It doesn't push stocks down, but it puts pressure on stocks. And you notice it put more pressure on small caps and emerging markets than anything. So they really came down. Of course, gold dropped the most. Let's take a look at their charts here really quick. You look at gold, which has been doing pretty well, but unable to get above 1350. And holding some ground at these lows. There's a lot of long lower shadows in this area, so there's some support here. If this breaks out of that Bollinger Band to the downside, and you look at it on the dollar index here, that would accompany a break to the upside. I mean, this is really narrowing. We're going to get a breakout one way or the other in the dollar, and if that's the kind of chatter we get from the administration, the strong dollar, we could definitely get. Now, I don't think it'll be like a move back up to 100, 102, but definitely some of that chatter can push us up to 90, 94, 95. And as we've seen, that will put some pressure, and especially in emerging markets. If you look at how emerging markets have been doing on a long-term basis, you can see a very similar looking chart on emerging markets on a long-term basis, and similar to the S&P, where you have this long-term MACD that's gotten really high, starting to grind a little bit, and you're going to see that. But if you look at EEM relative to SPY, because they've both been going up sharply, and you can see that EEM's been outperforming. If that strong dollar, if that chatter turns into something real, then look for some underperformance on emerging markets from an asset class standpoint. From a sector rotation standpoint, you can see here, if I were to zoom in on remember the dollar kind of started to rally right around this area, and that's about when everything started to fall. If I were to kind of look at this peak in the S&P, really through the end of the day, utilities and real estate, even with that relatively weakening housing price index, and really the weaker indicators we've had over the last month or two in real estate, those two sectors which have been so beaten up, holding value. In fact, those are the only two sectors that finished with gains today. Remember, those are the ones that are beaten up the most. Those are the ones there's going to be some value, some rotation opportunity here pretty soon. You can see strong dollar impacts energy, but the energy rallied with the strength in crude oil, because remember, the dollar is not the only thing that impacts these things, right? So energy stocks held up with crude oil holding up in the face of a strong dollar. That's how strong crude oil was. If it wasn't for the strong dollar, crude oil would have killed it today. So that kind of gives you an idea of how strong and that's why energy stocks did so well. But material stocks didn't have the same benefit, and that strong dollar really pushing down all those metal prices. You can also see too healthcare, some of these momentum areas, technology, consumer discretionary, consumer staples, also lagging behind and having one of the bigger losses on the day. So it kind of just shows you that this little pullback, and again, I zoom out to the high that we have all the way till now. So this is kind of this is the pullback that we're having. Look at energy and material stocks have been the worst performer, but look at consumer staples down there. In fact, those are really the only three that have lagged the market as a whole. Consumer discretionary, technology matching, consumer discretionary outpacing, and there's your two beaten up sectors that also happen to be safe haven areas that typically do well when stocks pull back, but they're doing well because they have been so bloodied and beaten up that they're showing some opportunity. Okay, so for our trade idea of the day, keeping with that kind of strong dollar theme, you can see the Brazilian ETF dropped 2.25% today. But from a technical perspective, you see it kind of broke down below this 45 level. We had traded below that before on an intraday basis, but closed below that. It's been kind of a range. It's been really tightening up that range. MACD has been dropping below its moving average. Stochastic's dropping below its moving average. But closing below all these moving averages. We've been trading right around them, but it's got clearly below both of them. And also happened to get below the lower, with a tightening Bollinger Band, getting below that lower Bollinger Band. You can see when it does that, you expect it to start to push the lower Bollinger Band down. That being the case, of course, we're not going to be too aggressive here because, like I said, a strong dollar might be a temporary theme, but it's not going to be a dominant thing as, the dollar's been on a bearish trend for the long term. So if we say, okay, well, if I sell the 46 call option, that 30 to 40 delta in that April month, close to around 45, the weekly is just, they're too wide on the spreads. right now. So we'll go for that April 2036 and look at that 38 delta and sell the 46, buy the 48 call in case it takes off to the upside, protect ourselves in the worst case scenario. So that's what that's for. And you can see we're going to get a little bit more credit right now. In fact, we're getting 58 cents more credit. We don't need that. That's more credit than on a $2 wide spread than what it lowers our probabilities of success. So we want to make sure it keeps going down. And if it does, then the credit will go down to the level where it's acceptable enough to give me the highest probability of success possible. So kind of make sure, we kind of make sure, okay, we broke down today. If we bounce right back up tomorrow, I never get in. But if it holds this breakout and continues to push lower, then I get to that credit that gives me the high probability of success. I mean, already it's got a pretty decent odds. That number gets bigger as the credit goes down to where we want it to be. And you can see this break even of where we're at, where that looks like, what it looks like on the chart. That's that line right there. So we'd have to continue to break down, then get back up above back up above that middle exponential moving average in between, and then get back up above these highs. And of course, that's when you get to the crossover point where we get about the same loss as gain as we're trying to get. And that's where we want to be able to take that maximum loss for all the things we taught, or not the minimal loss, excuse me, avoid the maximum loss for all the reasons we talked about in last night's video. So again, a way to be able to say, okay, strong dollar in the temporary, what's that impact? Well, there's different sectors, especially that utilities and real estate. They're not really going up yet, though. So let's find something here on an asset class basis that strong dollar we can take advantage of. In this case, with one of the major emerging markets in that EEM. So with that said, thanks again for watching tonight. I really appreciate it. It was a crazy day. 4 days in a row. It's I saw the headline that we've had the biggest losing streak that we've had in 2018 or whatever it was, and it's like, it's a 4-day losing streak to a 38% Fibonacci retracement. That's on the large cap stocks. The small cap stocks, which underperformed today, are still showing the possibility for a decent bullish near-term low point. So come back tomorrow. Tune in tomorrow. We'll see if we get that bounce heading into the end of the week. Have a great evening, everybody. Thanks again for watching. Remember to like, subscribe, and comment on the video down below. Also, remember to follow me on Twitter for more content. Like and retweet tonight's Market Outlook tweet, and then also join the Market Outlook community on Facebook with the link down in the description. Have a great evening. We'll see you all tomorrow.